The U.S. Securities and Exchange Commission's much-anticipated innovation exemption for tokenized stocks did not arrive this week, despite a Bloomberg Law report on May 18 suggesting the release was imminent. The delay reflects mounting pressure from both global regulators and traditional market participants. Commissioner Hester Peirce moved quickly to temper expectations, clarifying that the framework would only facilitate trading of digital representations of real equity shares, not synthetic instruments. This shift narrows the scope of the proposed exemption and directly undercuts the more expansive version Bloomberg had described, which would have allowed crypto-native platforms to tokenize shares in companies like Apple or Tesla without the company's consent. Peirce's statement points to the SEC's January staff statement on tokenization, which drew a clear line between custodial tokens, where real shares are held in custody, and products that only offer synthetic price exposure. This distinction is crucial because it affects how tokenized assets are treated under existing securities law. By excluding synthetics, the SEC is limiting the types of tokenized assets that can benefit from the exemption, which could impact the broader adoption of tokenized equities in crypto markets. The pushback isn't just coming from within the SEC. Global regulators and exchanges have also raised concerns. The World Federation of Exchanges recently said, "Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now." A letter to the SEC, ESMA, and IOSCO urging stricter oversight of tokenized assets. This external pressure suggests that traditional market participants are worried about the potential for regulatory arbitrage and the disruption of existing market structures. Under the earlier version of the exemption, tokens could have been created by third parties and traded on decentralized platforms without necessarily granting token holders full shareholder rights like voting or dividends. This model would have allowed for a more flexible and expansive tokenization framework, but Peirce's clarification now limits it to real equity representations. This means that tokenized stocks will still require custodial infrastructure and investor protections that align with traditional markets. The implications of this delay are significant for crypto-native platforms and investors who are counting on a regulatory green light to tokenize and trade real-world assets. Without clear guidance on synthetic instruments, the market may struggle to develop a robust tokenization ecosystem. This could also slow the integration of traditional assets into decentralized finance systems, which rely on synthetic exposure to real-world assets for broader adoption. Peirce's comments also highlight the tension between innovation and regulation. While tokenized stocks offer a new way to access equity markets, they also introduce new risks and challenges that regulators are still trying to understand. The SEC's cautious approach suggests that it is prioritizing investor protection and market stability over rapid innovation. The next signal to watch is whether the SEC will issue a revised framework in the coming weeks, or if the delay will lead to further internal debates or external lobbying. If the agency tightens the exemption further, it could limit the usefulness of tokenized stocks in crypto markets. Conversely, if it finds a way to accommodate synthetic instruments under a controlled framework, it could open up new opportunities for tokenization and decentralized trading. In the meantime, market participants are left in limbo. Crypto-native platforms may. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Need to pivot to alternative models or seek regulatory clarity from other jurisdictions? Traditional exchanges, on the other hand, may see this as an opportunity to capture a larger share of the tokenization market by offering custodial solutions that comply with existing regulations. The stakes are high for both sides. For crypto platforms, the ability to tokenize and trade real-world assets is a key step toward mainstream adoption. For regulators, ensuring that these innovations don't undermine existing market structures or investor protections is a top priority. The outcome of this regulatory process will shape the future of tokenized assets and their role in global finance.